Hello and welcome to another video. So in this video, we will be actually going over the 2016 BFS paper 2A. Again, this is not for O levels or A levels. This is actually the Hong Kong secondary education exam. So it's only applicable to students attempting BFS paper 2A, and that's only applicable in Hong Kong. So if you are not if you're not attempting that exam, so please do not watch this video. So that's just a disclaimer. And students who are actually attempting that exam, then of course, you should continue watching it. So in this video, we will actually be looking at paper 2A. Paper 2A has 3 sections, A, B, and C, of which in section A and B, student has to attempt all the questions. Whereas in section C, student has only needs to attempt one question. If you look at the paper, generally speaking, right, of course, the paper covers questions from financial and managerial accounting both. And the type of questions that it has, it includes calculation and conceptual questions, right? So it's not only calculation, but it also includes some conceptual questions. For example, you might need to remember different accounting principles or different applications that we will see in the exam, or you will see in the exam. All right. So again, just a request that if you think this video is helpful to you, or if it's going to be helpful for your friends, then please feel free to share the video with your friends, and do not forget to like and subscribe to my channel for more videos, and there are many more other basic accounting related videos on my channel that you can actually watch. This video is going to be short because we are only going to look at questions from section A, which has 4 questions. So we will only look at 4 questions in total, which are worth of 24 marks. And only section A. All right, so let's get started with this thing. So let's look at question 1A. Question 1, right? So question 1 is basically what you are seeing in the question is that a trial balance is given to you, right? So you are looking at a trial balance, and if you are at this stage of the exam and you are preparing for the exam, you understand what a trial balance is. A trial balance is just a summary of different account balances in a company financial statements, right? And it's not really a financial statement. A company uses trial balance to prepare those financial statements, that is income statement, balance sheet, and cash flow statement, 3 main financial statements, right? So you're looking at a trial balance. Now, it is very important to understand that different assets would have balances on different sides. Trial balance has debit and credits. Debits always are equal to credit. If they are not, then there's an error. And actually, if you look at this trial balance, there's already a suspense account, which has a debit balance of $170,000, approximately $170,000, right? It's 170660. So what it is asking what it is asking is that you have to prepare a correct trial balance for the company and state one limitation of a trial balance, right? So basically a disadvantage. A limitation in this case, other similar word or a synonym for limitation would be disadvantage, right? So limitation basically means disadvantage. You have to write a limitation of the trial balance. So if you look at the trial balance here, and if you are, if you remember how the balances work. So for example, equipment. What is an equipment? Equipment at cost is basically an asset of the company. Now, if you remember, assets will have debit balance. Assets should not have a credit balance. But in this case, they have put it down on the credit side of the trial balance. So that is actually incorrect, right? So we need to correct this. So we need to actually correct this. So I have already placed this incorrect trial balance in the Excel. What we are just going to do is just move these numbers into correct columns, actually. So just a thumb rule, just write it down if you don't remember it. assets will have debit balance, liabilities will have credit balance, and equity will have a credit balance. Revenue has a credit balance, expenses has a debit balance, right? So if you remember if you remember this rule, then this question is very easy. So the 5 marks is you should be able to do it in 5 minutes, or maybe take 2 more minutes to review your answers. 7 to 9 minutes is a good enough time to finish this question actually. So let's move the numbers. So the first one you are looking at is actually the asset account, right? So it has a credit balance. It should have a debit balance, right? So it should have a debit balance. So we will move it to the debit side. Accumulated depreciation. Now, what is accumulated depreciation? Accumulated depreciation is a contra asset account. Now, because it's a contra asset account, it will have a credit balance, not a debit balance. So we will move this on the credit side. Inventory has a debit balance. Inventory is an asset and it has a debit balance. So this is on the correct side. Unearned revenue is basically a revenue that is earned in advance, right? So that's what unearned revenue means. Unearned revenue means that the company has received cash from its customer in advance and has yet to deliver the goods or perform the services, right? So basically, the company has received the money in advance, and now later they will perform the service or deliver the goods. So this is a liability because company has received the money in advance. So this is a liability. Unearned revenue is a liability. Liability has a credit balance, and this is shown correctly on the credit side. That's okay. Then retained profits. What is a retained profit? Retained profit is basically accumulation of profits of a company over the years. Now, this is a profit. They have used the term profit, not losses. If it was a retained loss, then the debit balance would be correct because then it would have that expense nature. But right now it has that equity nature because it's a profit. Company has accumulated that money over a period of time. So it has a credit balance, right? So we will move that to the credit side. Share capital, again, that's a pure equity. This would have a credit balance. We will move that to the credit side. Now, trade receivables. Trade receivables, what are trade receivables? So I also have a video on basic accounting terms. You can watch that on my channel, but trade receivables, are also known as accounts receivable, are actually companies' debtors. What happens is that sometimes company will sell goods on credit, right? So you have sold goods on credit, you have sold the good, but you haven't received the money yet. Now, because you haven't received the money yet, that becomes your trade receivable. The customer will pay you at some point in time, or they may never pay you actually, but that's a different concept. The nature here is that the company has sold the goods without receiving the cash. That's what a trade receivable is. All right, so this is an asset because it is expected that customer will pay in future. So this is an asset, and therefore it would have a debit balance. So we will move it to the debit side. Now you see, because of the suspense account, we need to remove the suspense account. It should balance without the trial balance, should balance without the suspense account. So we will actually delete this, and you will see the debits and credits are equal. Right, 2538330, no difference. So that would be the answer to your question 1, part A. Now, the limitation of trial balance is that if the accountant of the company forgets the entry, right, the trial balance can still balance despite the omission of the entry. So the accountant never recorded the journal entry, and the trial balance still balances. Right, so the company actually forgets about that entry, and it never gets recorded in the books. So sometimes it could be very crucial, right? So maybe company forgot to record a huge revenue number. Now what happens is that if the company, and the trial balance still balances, so if company forgets to record a huge revenue earned on the trial balance, then it also fails to record that on income statement, right? So now company is reporting less revenue when in fact company must have earned way more money and would have a higher profit. but now because of omission and the trial balances, the company has forgot to record that. So that's one limitation there. Let's move to the question 2. So this is question 2 from again section A, paper 2A. Right. So question, if you look at question 2, it's basically asking you to do some debits and credits, and also identify which ledger the entry will be recorded, right? So they have also given you an example. They've also given you an example, which is equipment purchase in cash, right? So again, here you need to remember those debit and credit rules. If you don't, no, don't worry. You know, I do have a video on that which actually explains all of these rules. So you can watch that video on my channel. It's there. So we will just quickly go over these, assuming that you actually know all these rules and you can make journal entries. And you also understand the nature of the accounts that are involved, right? So if you look at the example here, the example is equipment purchased in cash, right? So what is equipment? Equipment is an asset. And the company has purchased that. So that is the asset is actually going up because equipment is an asset. So whenever assets go up, we always debit, right? And then there's another asset called cash. So company has purchased the equipment using cash. So cash is going down. One of the asset is going up, one of the asset is going down. So the asset that is going up is debit, the asset that is going down is credit. The asset that is going up is equipment, so equipment is being debited, and then the asset that is going down is cash, so cash is being credited, right? And two different ledgers that are involved here. For equipment, it's general ledger, and for cash, it's cash book, right? So we are actually going to look at these transactions here. I again have the Excel thing here. And if you look at the transactions from A to E, right? So the transaction A is basically office rent paid by check, right? So what is office rent? Rent is actually an expense, right? So whenever there is an expense, it's usually debit. So we will debit rental expense account. That's the account name. And the ledger involved in this case would be general ledger. Now check, because they have used the term check, the account that we will use is bank instead of cash. So if they would have said cash, then of course it would be cash, right? So instead of, so let's say we replace the word check and we say cash, then we will change from bank to cash, right? And the ledger affected would be cash book. And in both cases, bank or cash, the ledger impacted would be cash book. Let's look at transaction B, which is goods purchased on credit. So goods purchased on credit, right? Companies purchasing goods, so debit purchases, which goes into general ledger. And because they're purchased on credit, we would have trade payables as credit because it's not paid by cash. And because it's not paid by cash, the ledger impacted would be purchases ledger because the purchases are on credit. Now, if this transaction again was on cash, so let's say goods purchased on cash, then the debit side will remain the same, but the credit side will change. Trade payables will be replaced by cash, and purchases ledger will be replaced by cash book. So that would be the difference there. Let's look at transaction C, which is bank loan acquired. Company is actually borrowing money from bank. So one asset will go up, that is bank, right? So the ledger impacted would be cash book because company has received cash after obtaining the bank loan. And then because bank loan is a liability, liabilities are credited, right? Liabilities will be credited. So we credit the bank loan, and then the journal ledger and the ledger impact would be general ledger. Transaction D, goods returned by credit customers, right? So the company sold the goods on credit. Now that customer is not happy with the product, or there's something wrong with the product, or the customer just doesn't like the product, right? It could be anything. So the customer returns the product to the company. So that would be return inwards. So debit return inwards, and the ledger impacted would be general ledger. And it said credit customer, not cash, right? So the item impacted here would be trade receivables, not cash. Or so trade receivable. So the company will credit trade receivable, and the item impacted in this case, the ledger impacted in this case would be sales ledger. Last transaction, which is interest income accrued. So right, interest income is accrued. It's not received yet. It is yet to be received. That's the meaning of word accrued, right? So interest income has to be received yet. So that's why it's interest receivable, debit interest receivable, ledger impacted would be general ledger, credit interest income, and again, ledger impacted is general ledger. Right. So that's question 2, not very difficult, and it's for about 5 marks here. Right. Let's look at question 3. So you see, first 2 questions are actually financial accounting related. Question 3 is managerial, and then question 4 actually is again about financial accounting and accounting concepts actually. So only one question. So in this paper, actually, one question is about managerial accounting from section A. I do not had time to look at other sections of this exam yet. So forgive me, I do not know what type of questions are in the section B. So from section A, you have actually 3 questions out of 4 questions for financial accounting and only 1 question on managerial accounting. But again, you have to look at the paper holistically speaking. This is just a part of the paper, just a part of the paper. So question 3 is, Thomson Company computes its annual predetermined manufacturing overhead absorption rate, right? So this is actually, the short form is POHR. This is about predetermined manufacturing overhead. It's a classic problem usually tested on the exam. So it's sometimes complicated, sometimes easy to deal with. We will see how difficult this problem is. Right, so in December 2014, it estimated that 50,000 machine hours would be required for the planned level of production in 2015. Right, so they have already done the calculation, the estimated calculation for 2015 in 2015, actually December 2015. The company also estimated that fixed manufacturing overheads would amount to $450,000, and manufacturing overhead would be $6 per machine hour for 2015. Then the actual manufacturing overheads for 2015 were $770,000, and the actual number of machine hours was 48,000, right? 48,000 hours. So they've given you the estimated number, and then they have given you the actual numbers. Now companies have to do this calculation because they don't get the actual numbers until later in the year, right? So they work on the estimations. So they basically work on estimations. That's why if you look at the formula for POHR, it's actually the estimated overhead expense over the estimated machine hours, or it's actually estimated activity. In this case, the relevant activity is machine hours, because that's what company is using. Right, so the first question for 2 marks is to calculate the predetermined manufacturing overhead absorption rate for 2015, which is nothing but simply estimated expense, which is given $450,000, over the machine hours, which is $50,000. Sorry, 50,000 machine hours. Right, so you simply divide those 2 numbers here. If you see, I am just simply dividing. I'm showing you the Excel formula. It's just simple division: $450,000 over $50,000, and that's fixed POHR, and then there's a component of variable overhead as well, which is $6. You will add 9 plus 6, and that will give you $15 as total manufacturing overhead. So this is actually the answer to 3A, part 3A. Then let's look at part 3B. In part 3B, you actually need to understand the concept of under or over absorption. So in this video, I'm actually not going to explain that what do we mean by under or over absorption, But in case if you would like to know, please comment down below in the video, and I will leave a description over there what we mean by under and over absorption. But if you look at the solution, you will actually understand what do we mean by it. So under and over absorption actually occurs because there's a difference between the estimated numbers and the actual numbers, which are available later in the year, right? So they have actually given you the actual manufacturing overhead for 2015 as $770,000 and machine hours were $48,000, right? So using $48,000 and the estimated PUHR, which was $15, we simply multiply two numbers together, right? So 48,000, which was the actual machine hours, times 15, which is the estimated rate, the company overhead expense should come to $720,000, right? Using the actual machine hours. But company actually incurred only $717,000. So what company has done is company has absorbed or recorded $3,000 more in expense, when in fact company incurred $3,000 less in expense, right? So we actually just need, so the company actually, so that's why it's an over absorption of $3,000. So one mark would be, I think one mark would be given for the word over absorption, that you have identified over absorption correctly, and then you have calculated the number correctly, which is $3,000, right? But you should actually look at the marking scheme, how they have allocated the marks to the component, because I don't know how they have allocated. But this is actually the answer to the 3B, which is $3,000 over absorbed, because company, based on the company calculation, the expense should be $720,000, but actually company incurred $717,000, right? So there is a $3,000 difference there. So the company has absorbed or recorded $3,000 more in expense. So company needs to reduce that. And that's exactly what your part C is actually. So for part C, for the under-absorbed or over-absorbed manufacturing overhead calculated in B, state the accounting treatment and its impact on the net profit for 2015, right? So you have two components there, accounting treatment and its impact on the net profit. So impact on the net profit basically means whether either it will change. The change could have either increase or decrease or no change. There are only three options here. There's either no change, increase in net profit, or decrease in net profit. Just look at this. Company has recorded $3,000 more in the expense. They have to reduce it, right? So that means the net profit is going to be increased, right? So net profit is going to increase. Net profit is going to increase. And at the same time, the company needs to reduce the cost of goods sold because they have to reduce that $3,000, right? So reduction in cost of goods sold and increase in net profit. That is the answer to your part C. For part D, state one variable manufacturing overhead cost which increases the usage of machine hour. Right, so state one variable manufacturing overhead cost which increases the usage of machine hour. So electricity, right? That's one variable there, or depreciation of machine. So as machine hour will increase, the electricity expense will increase, the depreciation will increase. Similarly, the machine maintenance cost will increase. So for example, repair expense or the lubricants or machine oil, anything like that. So all of these are variable manufacturing overhead costs, which will increase with the usage of machine hour. So that's what the question means. As machine hour goes up, what is the other item that will also go up? It has to be variable in nature. So electricity is very simple example here, right? So as soon as machine hours will go up, if you use a machine more, it will going to incur more electricity expense at the same time, right? So this is the discussion over question 3 from section A of this paper. Let's move to question 4. Question 4 is actually about accounting principles. So it's going concern. Going concern is an accounting principle. It's an important assumption for the preparation of financial statements. Explain going concern assumptions, right? So going concern assumption basically means that the business is going to continue for foreseeable future, and there are no liquidation, or there's no such problem. There is no bankruptcy problem there, right? So that's what going concern actually means. How are non-current assets valued when the going concern assumption no longer holds for a company? Now, what this question means is that the company is going to liquidate itself. If company is not expecting to liquidate itself, then company reports the assets on historical cost. Historical cost is another accounting principle, which basically states that the company is going to record the asset at its cost. But if the going concern assumption doesn't hold, that means the company is going to be liquidated in the foreseeable future. That means the company has to report the assets on its fair value, or the liquid, or basically the net realizable value, the value at which the company is expecting that they will receive at the disposal of the asset. So that's what it means. Part C, basically, again, it's an application here. Apply accounting concept here, accounting principle concept here. So the directors of NICE Limited noticed that the fair value of the existing equipment had increased dramatically at the end of 2015 due to the anticipated shortage of supply of the equipment in the next 2 years. Although the company would continue to use the equipment, the directors decided to record the fair value of the equipment in the financial statement of 2015. Right, as I discussed, so you see part A and part B are kind of related to part C. So as I mentioned, that companies are required, they can report assets on fair value, but they have to elect for it, right? Otherwise, companies must report their assets on historical cost, which basically means that company cannot change the value of its asset, and they have to record it at its purchase price. So at whatever price it was purchased, the company have to record it at that price. Now, this company has tried to record the asset at the fair value because the value of the asset has gone up. So it's beneficial for the company, but the company cannot do it unless approved, or accounting standards allow them to do so. But at this moment, that's not the case. So historical cost principle is in violation in this case, and you can explain as I discussed here. You can actually read the answers. I think they should be available somewhere. And for part D, that is actually about calculate the balance of allowance for doubtful debts account of NICE Limited as 31st December 2015. So all you need to do is basically, simply multiply 450,000. Let's open the brackets there. So all you need to do is simply multiply 450,000 times 1% plus 180,000 minus 20,000 minus the 20,000 times 3%. Right, we will add one more bracket here to make it complete, and then 60,000 times 10%, and that is your answer, 15,300. That would be the balance for allowance for doubtful debts. I also have a video on if you have confusion over accounts receivable on actually provision for doubtful debts. I already have a video on that too on my channel, so please go ahead and watch that, and that will make you understand how to do these calculations. But fairly, the section A, the questions here were fairly easy, not that difficult. As long as you have done enough practice and understood the concepts very well, you should be fairly able to answer these basic accounting questions on your exam. So I wish you the very best on your exams, and thank you very much for watching this video till the end if you have watched it. And if you think this video was helpful to you, please don't forget to subscribe, like, and share with your friends. And thank you very much for watching this video.